The global geopolitical equilibrium, which had been characterized by a tense but functional standoff throughout 2025, suffered a terminal rupture during the final weekend of February 2026. The launch of Operation Epic Fury represents more than a localized military engagement. It is a fundamental reconfiguration of the Middle Eastern security architecture. This weekend, Situation Report details a joint U.S.-Israeli campaign of unprecedented scale, involving over 2,000 sorties within a 24-hour window, aimed at the total strategic degradation of the Iranian regime. The confirmation of the deaths of Supreme Leader Ayatollah Ali Khamenei and the highest-ranking officials of the Islamic Revolutionary Guard Corps, IRGC, has introduced a black swan event into a global market that was already brittle and over-leveraged. As the Monday market outlook takes shape, the narrative is dominated by the sudden transition from front-page risk to bottom-line risk. For months, market participants had largely looked through the noise of regional skirmishes, assuming that de-escalation remained the baseline. However, the precision strikes on Tehran, Isfahan, and Qom have shattered this complacency. The immediate consequence is a violent rotation into safe haven assets, as the reality of a functional blockade in the Strait of Hormuz and the closure of the world's busiest international air hub in Dubai begins to be priced in. The structural shift in the global trade architecture is not merely a temporary dip, but a regime change. The 12-day war of 2025 was a precursor to this event, but the current operation's goal of active displacement suggests a prolonged campaign that will sustain a high geopolitical risk premium for the foreseeable future. The analysis indicates that the Monday market playbook must now account for a world where energy security is no longer guaranteed and the connective tissue of global travel and logistics has been severed. The bottom line up front for Monday morning is a stark risk-off mandate. The geopolitical event is defined by the successful decapitation of the Iranian leadership, an act that has triggered an immediate and asymmetric retaliation across the Gulf Cooperation Council (GCC) region. Iran's response has targeted the very heart of global commerce, specifically the UAE, Kuwait, Qatar, Bahrain, and Oman, effectively turning the world's primary energy corridor into a combat zone. The functional threat to the Strait of Hormuz, where over 200 commercial vessels are now anchored in open waters, represents the most significant supply chain shock since the 1970s. The supply chain shock is exacerbated by the total shutdown of the Jebel Ali port and the Dubai International Airport. These are not just regional hubs, they are the central nodes for the global automotive, electronics, and breakbulk industries. The fires at Jebel Ali, triggered by debris from intercepted Iranian Fateh-2 hypersonic missiles, have paralyzed a port that handles nearly 1 million RORO units annually. Simultaneously, the grounding of all flights at DXB has severed the primary air bridge between Europe and Asia, impacting more than 1,500 flights and trapping thousands of passengers in a full war scenario. The market reaction is expected to be a, quote, haven first, ask questions later rotation. Global equities are poised for a sharp pullback, while the safe haven trio oil, gold, and the US dollar are surging. Gulf stock exchanges in Dubai, Abu Dhabi, and Kuwait have already implemented emergency trading suspensions to prevent a total valuation collapse. The analysis suggests that the duration of this conflict and the subsequent stability of the Iranian succession will be the primary drivers of volatility throughout the week. The technical and fundamental playbook for Monday morning signals a violent repricing of global risk. Safe haven assets are experiencing a vertical expansion as capital flees the uncertainty of growth-sensitive equities. Brent crude is projected to open at an 11% premium, targeting the $74 to $80 per barrel range immediately, with a clear pathway toward $100 or even $120 if the blockade of the Strait of Hormuz becomes structural. This price action is driven not just by fear, but by the physical reality of 15 million barrels per day being trapped behind Iranian lines. Gold is exhibiting its classic role as the ultimate store of value during Epic Fury. The metal is approaching $5,400 per ounce, supported by a 2.25% spike that coincides with a major technical breakout against the S&P 500. The US dollar is also appreciating as investors scramble for liquidity and the safety of US treasuries, even as US military bases in the Gulf remain under fire. In contrast, risk assets are in a state of freefall. The S&P 500 is expected to pull back sharply as sectors like aviation and travel plunge due to airspace closures and surging fuel costs. The technical significance of the gold to S&P 500 ratio cannot be overstated. By breaking its critical 0.60 neckline, the ratio indicates that investors are aggressively shifting capital out of financial assets and into inflation hedges. Historical analysis reveals that such breaks often precede multi-year corrections in equity valuations, reminiscent of the early 2000s and the 2008 financial crisis. The risk-off rotation is now a mechanical reality, as automated trading systems and institutional managers move to minimize drawdowns and preserve capital. Operation Epic Fury, launched on February 28, 2026, is the result of a meticulously planned maximum pressure 2.0 strategy by the Trump administration. This joint U.S.-Israeli operation was designed to achieve what years of sanctions could not: the dismantling of Iran's nuclear and ballistic missile capabilities. The operation utilized a daylight strike tactic to catch the Iranian leadership off guard, focusing on strategic installations in Tehran, Isfahan, Qom, Karaj, and Kermanshah. The scale was massive, featuring a naval armada led by the world's largest warship, the USS Gerald R. Ford, which provided an Aegis shield for Israel, while the USS Abraham Lincoln served as the offensive sword from the Arabian Sea. The human and political toll of the operation has been catastrophic for the Iranian regime. The confirmation of the death of Supreme Leader Ayatollah Ali Khamenei, along with his family and top IRGC commanders, marks the most significant leadership change in Iran since the 1979 revolution. Over 200 personnel were reported dead inside Iran within the first 24 hours of the strikes. President Trump's rhetoric has been explicit, framing the bombs as a tool for regime change and urging the Iranian people to take over your government. The strategy appears to be one of strategic degradation. By eliminating the command and control structure of the IRGC, the US and Israel aim to neutralize Iran's ability to coordinate a sustained regional war. However, the immediate saturation strikes by Iran's remaining forces using Fateh-2 hypersonic missiles against US and GCC targets suggest that the regime disruption phase is only the beginning of a much larger confrontation. The 12-day war of June 2025 was the prologue. February 2026 is the decisive act. The retaliation following Operation Epic Fury has effectively weaponized the geography of the Persian Gulf. Iran launched approximately 300 missiles and drones in a coordinated wave targeting 8 regional nations, with a focus on U.S. military installations and critical civilian infrastructure. The human cost includes 3 U.S. service members killed and 5 seriously wounded, marking a significant escalation in American direct involvement. In Israel, the toll stands at 9 dead across Tel Aviv and Beit Shemesh, while Dubai, Doha, and Manama have all reported explosions and damage to their international airports. The contagion map shows a deliberate targeting of nations hosting the U.S. Fifth Fleet and major airbases. Bahrain, Qatar, and Oman have faced direct kinetic strikes. The Duqm port in Oman, a strategic hub used by the U.S. Navy to bypass the Strait of Hormuz, was hit, signaling Iran's intent to close even the alternative logistical routes. In the UAE, the damage has been both symbolic and economic. A hotel on Palm Jumeirah was set ablaze, and a concourse at Dubai International Airport sustained drone damage, prompting a total shutdown of the city-state's connective tissue. This regional fallout has triggered a massive evacuation plan, with India coordinating Vande Bharat 2.0 for the 9 million Indian citizens living in the Gulf. The panic all around, described by residents in West Asia, reflects a fundamental loss of confidence in the regional security umbrella. The analysis suggests that the economic contagion will spread through the current account deficits of energy importers like India and Thailand, as both nations scramble to activate economic war rooms to shield themselves from the fallout of the Gulf crisis. The Strait of Hormuz is the primary transmission mechanism for this geopolitical shock into the global economy. At its narrowest point, the strait is only 21 miles wide, with shipping lanes just 2 miles wide in either direction. It is the world's most critical oil transit choke point, handling 20 to 25% of the world's daily seaborne oil, approximately 14 to 15 million barrels per day, and 20% of the global LNG trade. Iran's navy has functionally threatened to close this artery, effectively weaponizing the world's energy supply. The physics of the blockade are devastating. Over 200 vessels are currently anchored, unable or unwilling to transit the combat zone. Unlike other choke points, the options to bypass the Strait of Hormuz are extremely limited. Only about 4.2 million barrels per day can be redirected through existing pipelines in Saudi Arabia and the UAE. For nations like Iraq, Kuwait, Qatar, and Bahrain, there is no alternative route. This creates a structural rather than proportional price premium, as the global energy market faces a physical deficit that cannot be papered over by financial hedges. The implications for Asian markets are particularly severe, as 70 to 80% of the oil passing through Hormuz is destined for China, India, Japan, and South Korea. India, for example, imports 80 to 85% of its LPG requirements through this single channel and maintains no strategic LPG reserves, making its cooking gas supply chain uniquely exposed. The analysis suggests that even a partial disruption risk embeds a $20 to $40 per barrel geopolitical premium, pushing prices toward more than $110 as marine war insurance rates continue to climb. The global oil market is currently pricing in the disruption of the Strait of Hormuz through a three-tiered risk framework. Tier 1, the baseline, is the immediate Monday reality, with Brent crude projected to open between $74 and $80 per barrel. This represents an 11% spike driven by the initial shock and the halting of 200-plus tankers. In this tier, the market is pricing in a geopolitical risk premium rather than a total loss of production facilities. Tier 2, sustained closure, projects prices in the $100 to $120 per barrel range. This scenario is realized if Iran successfully mines or blocks the strait for a prolonged period, forcing a true physical supply deficit. At this level, the mechanical impact of Iran's own barrels is secondary to the loss of Iraqi, Kuwaiti, and Saudi exports. Tier 3, worst case, sees oil surpassing $120 or even $130 per barrel. This would be triggered by kinetic strikes destroying major Gulf refinery infrastructure, such as Iran's Karg Island hub or the Jebel Ali energy complexes. The analysis indicates that these prices are not just tickers, but economic poison for developed nations struggling with inflation. A sustained Tier 2 or Tier 3 shock would likely trigger a global recessionary environment, forcing central banks to halt interest rate cuts or even raise rates to combat surging energy costs. China, which purchases 80 to 90% of Iran's crude exports, is uniquely vulnerable. Any strike on Iranian supply would force Beijing to compete in the global market for replacement sources, driving prices even higher for everyone else. The consensus among analysts is that OPEC Plus is unlikely to offset the Iranian shock in the short term. On Sunday, March 1, 2026, the voluntary V8 group within OPEC Plus, including Saudi Arabia, Russia, and the UAE, agreed to a modest production increase of 206,000 barrels per day. While this was greater than the modest 137,000 barrels of oil per day increase previously expected, it represents less than 0.2% of global supply, a drop in the bucket compared to the 14–15 million barrels of oil per day potentially trapped behind the Iranian blockade. The fundamental issue is not a lack of production capacity, but a lack of export capacity. Saudi Arabia and the UAE hold the vast majority of the world's spare capacity, exceeding 5% of global output, but both nations rely on the threatened Gulf waters to export their barrels. Riyadh has reportedly been rampaging production in anticipation of the conflict, but this capacity is effectively stranded if the Strait of Hormuz is closed. The move by OPEC Plus is being characterized as tactical and symbolic rather than a material fix for the market. Prices will respond to the status of shipping flows and maritime insurance premiums, not to small adjustments in production targets. As the conflict intensifies, the physical inability to move crude renders much of the global spare capacity irrelevant to the immediate price discovery process. The paralysis of global logistics following Operation Epic Fury is most visible in the dual shutdowns of Dubai's Jebel Ali port and international airport. Jebel Ali is a premier maritime commercial gateway for a region of 3.5 billion people, handling over 80 weekly services to 150-plus ports. Its current state of emergency, with fires triggered by intercepted missiles, has led DP World to suspend all operations. This is a critical blow to the automotive industry, as Jebel Ali hosts 930-plus automotive companies and is a central hub for RORO units and spare parts. The aviation sector is facing a parallel crisis. Over 1,500 flights have been canceled globally as Dubai International, the world's busiest international hub, went dark. Qatar Airways has grounded all flights, and major airlines like British Airways and Singapore Airlines are rerouting to avoid Gulf airspace. Rerouting cargo around the Cape of Good Hope instead of using the Suez-Hormuz corridor adds 7 to 14 days to transit times and exponentially increases freight and insurance charges. The analysis suggests that this is no longer an outlier event, but a recurring condition of global trade in 2026. More than 52% of global companies already reported losing more than a month of operational time per year due to logistics disruptions even before this conflict. The current paralysis in the Gulf will likely force a permanent redesign of sourcing footprints, accelerating nearshoring and friendshoring strategies as uncertainty becomes a structural constraint. The economic ripple effects of Operation Epic Fury point toward a potential 1970s-style stagflationary shock. The mechanism is a direct feedback loop. Surging oil and shipping costs lead to a re-acceleration of global inflation, which in turn forces central banks to pause interest rate cuts or pivot back toward hikes. This is particularly dangerous for an economy that is already flashing signs of stagflation light. The market was already brittle, with expectations of 14 to 16% earnings per share growth for 2026, forecasts that are now fundamentally at risk. Asian and European economies face the highest exposure. China, as the world's largest energy importer, is uniquely vulnerable to a prolonged supply shock that disrupts the 80 to 90% of Iranian crude it relies on. In India, the conflict threatens not just energy, but the entire farm economy through the fertilizer supply chain, as 60% of the LNG used in Indian urea manufacturing is imported from Qatar and must pass through the Strait of Hormuz. The structural nature of this shock is emphasized by the breakdown in the S&P 500 to gold ratio. Valuations were already stretched, with the cyclically adjusted price-to-earnings ratio near 40, reminiscent of the 2000 dot-com bubble. A sustained oil shock at this juncture would likely trigger a risk-off period, where only defensive cash flow businesses and hard assets provide protection. The Don Roe Doctrine, a more assertive U.S. approach in the Western Hemisphere, suggests that geopolitical volatility is now a feature, not a bug, of the global macro environment. The gold to S&P 500 ratio has emerged as the ultimate technical indicator of capital fleeing risk for safety. The ratio has decisively broken its critical 0.60 neckline, a level formed by triple bottoms in 2018, 2022, and 2024. This break signifies a regime change in the global trade architecture, moving away from financial assets and toward hard assets. The ratio is projected to surge toward the 1.26 to 1.5 range, mirroring the revaluation zones seen during the 2011 gold bull market. The rationale behind this shift is the monetary system change trade. As the S&P 500 sits at historically elevated levels, approximately 2.3 times GDP, the compressed gold ratio suggests that equities are overvalued relative to tangible stores of value. Historical data shows that gold typically outperforms equities by 37% during U.S. recessions, and the current Epic Fury shock provides the perfect catalyst for such a correction. The analysis suggests that the standard geopolitical playbook, a sharp but brief sell-off followed by a rebound, may not apply here if inflation flares and forces higher rates. Instead, the market is seeing a correlated dip, where even gold may pull back briefly during an acute equity crash before decoupling and recovering much faster than stocks. The current 2025-2026 break below the 100-year trend line in the S&P 500 to gold ratio is steep and sustained, signaling a fundamental shift in market sentiment. The strategic outlook for the week ahead is governed by two primary paths: Path A, de-escalation and stabilization, and Path B, escalation and recession. In Path A, the Iranian Interim Leadership Council, currently composed of President Pezeshkian, Judiciary Chief EJ, and Speaker Ghalibaf, prioritizes regime survival over regional war. If the conflict remains localized and shipping resumes, markets could stabilize as the initial risk premium is digested. Path B is significantly more grim. If Iran doubles down on proxy warfare and successfully mines the Strait of Hormuz, or if the US and Israel strike Iran's Karg Island oil infrastructure, energy prices will likely surpass $120 per barrel. This would trigger a global recessionary environment, exacerbated by the fact that US military bases in the Gulf are now direct targets for Fateh-2 hypersonic missiles. The succession crisis in Iran, with Ali Larijani and Alireza Arafi emerging as de facto leaders, adds a layer of unpredictable succession risk that markets hate. The analysis indicates that the Trump administration's maximum pressure 2.0 is moving beyond containment to active displacement. The next 48 hours are critical. The missile math will determine the market's fear index, VIX, as analysts watch for saturation strikes against the Aegis defense systems on U.S. destroyers. President Trump's ahead-of-schedule operation suggests that Washington is prepared for the long-term endgame of regime change, regardless of the immediate market turmoil. As the first trading week of March 2026 unfolds, the analysis identifies four critical areas for monitoring. First is the Strait of Hormuz traffic. The status of the 200-plus anchored vessels and the marine insurance rate volatility will be the first signs of whether the blockade is temporary or structural. If insurers continue to issue cancellation notices, the supply chain for 20% of the world's oil remains effectively, quote, dead in the water. Second is the Gulf market reopenings. When the suspended UAE and Kuwait stock exchanges reopen, the scale of contagion selling will reveal the true extent of regional capital flight. Third is the Iranian succession. The stability of the Temporary Leadership Council, particularly the roles of Ali Larijani and Alireza Arafi, will dictate Tehran's retaliatory posture. Finally, monitor Washington's response. Any war powers vote in Congress or further regime change rhetoric from the White House will signal the duration and intensity of the campaign. In conclusion, the events of February 28, 2026 have shattered the illusion of a low-volatility global market. The epic fury of the US-Israel strikes has triggered a chain reaction that weaponizes global choke points and forces a violent rotation into safety. Whether this represents a generational buying opportunity or the beginning of a stagflationary depression depends entirely on the missile math of the coming days and the resilience of the global supply chain architecture. The playbook is clear: protect margins, hedge for inflation, and monitor the strait. The convergence of Operation Epic Fury and the subsequent regional retaliation has created a quote perfect storm for the global economy. The analysis suggests that we have moved beyond the era of just-in-time efficiency into an era of just-in-case survivalism. The 10,000-word reality of this conflict is that it targets the connective tissue of the world: energy at Hormuz, logistics at Jebel Ali, and finance in the S&P 500. The technical break in the gold to S&P 500 ratio above 0.60 is the most durable signal of this change, suggesting that the decade of equity dominance may be yielding to a decade of hard assets. As central banks lose their ability to cut rates due to energy-driven inflation, the complacency that defined 2025 has been replaced by the epic fury of a new geopolitical reality. The global market is not just reacting to a strike, it is pricing in the end of the post-Cold War stability. Investors must now navigate a landscape where the standard geopolitical playbook is being rewritten in real time by hypersonic missiles and decapitated regimes.